we were expected to buy growth financials, but we had kind of a unwritten rule. We kind of always were underweight the financials in our benchmark, because growth financials in and of themselves always blow up. Because if you're growing fast, that means you're making loans, and your credit quality is deteriorating the faster
You're
you
making
grow.
some bad decisions.
You're making some bad decisions, and there's growth financial one financial growth stock after another that always blows up. So let's look at private credit. It started off, totally legitimately. It was a niche market. The great financial crisis occurred. Banks weren't making risky loans. And it was probably a good asset class when it started, and there were good returns. But the fees were 3 to 4%. Tremendous fees. I mean, the average mutual, fundamental equity mutual funds, like 60, 70 basis point fees. When you get 3 to 4% fees, you're incentivized to grow as big as you can. So it started off small, then it attracted competition. Wall Street started its pitch book, bond equity-like returns with bond-like volatility, and they were off and running, and the thing just exploded. And so as you get, and in my piece, I noted that the last 2 years, 24 and 25, facilitated by the banks lending these guys money, the asset class grew 50 to 75% by some estimates. So minimum 50% growth in the last 2 years. So what happens with that last spurt of growth? Like you said, they don't do the work. It's about getting the deal done. So people are competing for the same piece of paper, and they might give that guy better terms than the other guy, and that's how the credit quality deteriorates. And we don't know it because they're just trying to get the loans so they can grow their book and capture the fees.
Yeah. And so then, it's almost like financial gravity, right? There's an inevitability there. Eventually there has to be a reckoning. That's kind of one of the things that I keep coming back to, and I know you do too, is that, the redemption cycle that we're going, the redemption wave, it's really a wave. It's almost a slow motion shadow bank run. It's not quite price discovery, but it's sort of like price discovery, because you can't have, all of these institutional investors particularly just start to look at these private credit funds and think, I need to get my money out if there's not something worthwhile for them to say we need to get their money out over. In as many ways, it's just, simple bubble dynamics that we've seen everywhere through history. The question I think a lot of people are asking is, okay, if we have that credit cycle shift and there is something to it, where are the avenues for contagion? Because like you said earlier on, and I absolutely agree with you, it never stays contained to just private credit. So private credit starts to become more of an issue, and it already really is, but it starts to become more of a mainstream issue, a Main Street issue than strictly a Wall Street issue. Where does it go from there? Other than, junk bonds is the immediate one adjacent. Are we going to see a problem crop up and say something like CLOs and package loans, leverage loans and syndications and things like that?
Yeah, that's, that's next on the list, because a lot of these CLOs are involved here, and, there could be some credit downgrades eventually from some of the rating agencies. And then, once credit downgrades happen, some of these institutions are forced to sell. I would contend that people will start selling before the credit agencies are always notoriously late. So we're going to start to see some liquidity problems, and we're already starting to see it. I mean, when you get a whole sector that was driving the marginal credit creator of the system frozen, the knock-on effects begin. And so you're going to see it's going to be a feedback loop between the real economy, because, these companies need more credit to keep the lights on. And so it just starts to feed back, and then it spills over into other credit markets. The banks rein in, they stop lending, and it just kind of cascades throughout the economy.
And another thing we're seeing too, which goes along with this, is the shift in behavior. I think is one of the biggest and clearest warning signs that you can get, where you see the insiders. Yes, they talk out one side of their mouth, telling the public that everything is fine. On the other side of the mouth, Blue Owl's was a perfect example here. Suddenly they're going on these road shows trying to convince investors that everything is fine. Before they said, there's nothing to see here. Another big one to me is, we've heard a lot about SRT, significant risk transfers, and how some firms are trying to use unfunded significant risk transfers to transform some of these portfolios. Does it seem like to you, as it does to me, that some of these insiders, yes, they say everything is fine, don't worry about it, we've got everything covered, but yet it's not what they say, what they're doing. They're reaching for protection. A lot of it was reminiscent of the 2008 crisis. And I don't want to make that direct comparison, but the 2008 crisis in terms of behavior, before it really fell off, what you saw was a huge demand for hedging, a huge demand for SRTs, back then credit default swaps. You kind of get the sense that that's taking place here. I don't know if you saw anything like that in what you work on and what you're going through.
Well, the Bank of International Settlements is talking about SRTs. So once you start worrying about your balance sheet, you go from growth mode to protection mode. And if every player starts doing that, the credit engine stops and then it feeds on itself. So it becomes a self-fulfilling prophecy. People, look, I'm a big believer everything happens on the margin. And, once the credit starts flowing, the second derivative starts to impact everything throughout the system. But, not all at once. And in 2007, I was talking to the bond guys at BlackRock, and it was going on. It was already starting to happen, but the equity markets had that concentration. And, the story back then was that China is the new king of the world. And so everything that was working in 2007 was China related. Well, eventually that blew up too. And what's working now, the only thing that's working in the stock market is AI. But people look at the stock market and say, oh, it's near all-time highs. Everything must be fine. No, underneath the surface, it's not fine. And quite frankly, I talked to my quant hedge fund guys in equities. They say we're seeing things we haven't seen ever. And they're just like amazed. And they're seeing there's all these 6, 7, 12 standard deviation events going on almost every week. That when that's going on beneath the surface of the indices, you should be very, very concerned and less tolerant of risk in your portfolio, because we're starting to see there's leverage issues. There's margin. There's so much margin in the equity markets. And when this goes, it could go fast. I'm not calling a top. I'm not calling a crash, but my experience tells me once the markets realize that we'll shift from the economy's fine to bad in a heartbeat, and then everyone will try to exit at the same time.
It's like fragility, right? I mean, that's what we're really talking about. The system is fragile. It's very top heavy. And under that kind of situation, it can go on for a lot longer than you think. The old Keynes quote here, but there are a lot of signs, a lot of red bells that are flashing, a lot of warning signs that are flashing. The other one that people talk about is the lack of breadth in the marketplace. I know you just touched on it a little bit. Is that something that you also look at and say, this really does not look good here? I mean, most of the returns you mentioned already, semiconductors and AI adjacent. Is that one of the biggest red flags that you're seeing, or is it really more liquidity, money flows, or is it all of them together? Same thing? Is it just the sentiment has gotten overdone? What's really going on beneath the surface?
Well, the top of the order book in the S&P futures is quite small, and liquidity works both ways. Liquidity can, kill you on the downside, but it can also squeeze you if you're short on the upside. And I think when the war began, if we go back to before the war started on February 28th, the market was top heavy. Private credit was all the issue. The markets were starting to fade. People were worried, and fundamentals. And if you go back, the 10-year yield was breaking 4% right before the war. Then the war happened. And then we had the peace agreement, or the market started to expect a peace agreement. And we had and then the last gasp of the AI credit impulse, the markets took off. Most fundamental investors missed it. The people I talked to were just amazed, given all the fundamentals they were seeing. And here we are.
It made no sense, right, Ed? It didn't make any sense. I mean, how did the end, or at least the theoretical end of the Iran conflict, fix all of those pre-existing problems? It was as if the market just said, oh, private credit, we don't care. Yeah, the 10 years below 4%, the 2 years down to 338. We don't care. The Iran conflict's over. I mean, it didn't make any sense how the market just rocketed off of, what was it, April 8th for the second year in a row? It made no sense.
It made no sense, but from a flows technical standpoint, it was a low liquidity market can squeeze just to the upside, and that's what it did. And semiconductors did have good fundamentals. I mean, Micron was a 60 billion market cap 13 months ago. Then it got up to about $1 trillion market cap. Phenomenal earnings, peak margins, but the problem is that's it. I mean, you do not buy Micron at 86% gross margins for a company that traditionally has 30 to 40% or something crazy like that.